America woke up to a financial nightmare that nobody saw coming. In a single day, markets collapsed and wiped out billions of dollars in wealth, leaving stunned investors wondering how it all unraveled so fast. Swirling rumors of tariff wars and diplomatic showdowns fed the uncertainty, yet the most shocking part was how quickly years of economic growth could be undone. The chaos began when tariffs, meant to protect domestic industries, backfired in spectacular fashion. Instead of strengthening American business, they triggered a domino effect that sent the stock market into freefall. Overnight, leading tech giants saw their valuations plunge, sparking panic on Wall Street as traders scrambled for lifeboats. Witnessing companies like Apple, Nvidia, and Tesla tumble was like watching the pillars of innovation crumble. Apple, with a market cap that once towered above $2 trillion, endured a stark drop that erased well over $100 billion in a flash. Nervous whispers about supply chain disruptions and cost spikes only deepened the sense of dread. Nvidia, a powerhouse in artificial intelligence chips, faced its own crisis when shares fell sharply. Investors had banked on unstoppable growth from AI demand, but the tariff news upended that optimism. Suddenly, nobody was sure whether a high-tech future could outrun this new era of economic protectionism. Then there was Tesla. For years, it embodied American ingenuity, building electric cars and launching rockets into space. When its share price nosedived, the sentiment was that if even a visionary brand couldn't weather this storm, perhaps the entire market was at risk. Between production lines, supply partners, and global expansions, nothing remained untouched by the tariff tremors. The meltdown spread beyond tech, slamming major airlines struggling with rising fuel prices. Delta announced profit cuts linked to new tariffs on Canadian fuel sources, igniting fear across the travel sector. American Airlines and United weren't spared either, as both stock prices plunged. Suddenly, the once booming airline industry seemed vulnerable to unpredictable trade skirmishes. Hedge funds also flailed under mounting pressure. When the world's largest investment firms began offloading stocks en masse, the panic spread like wildfire. Billions were pulled out of the market in mere hours, pushing even cautious investors into full-blown sell mode. The shockwaves reached major banks, prompting speculation about an oncoming recession. On Main Street, fear took hold as everyday consumers braced for higher prices. Retailers like Walmart saw their valuations drop amid concerns that tariff-induced inflation would squeeze household budgets. Just as Americans were regaining confidence in the economy, the possibility of job cuts and slowing wages loomed on the horizon. Cryptocurrency enthusiasts also discovered they weren't immune to broader financial shocks. Bitcoin dipped as fearful investors sought safer ground. Hopes that digital currency might shield traders from economic turbulence faded when even crypto markets felt the sting. It was clear no corner of the financial realm remained untouched. As the 10-year Treasury yield dipped, analysts warned it was a classic sign of risk aversion. Market watchers feared a recession was brewing, fueled by trade disputes and eroding trust in official economic policy. Nobody could ignore the meltdown anymore. It wasn't a blip or a minor correction. It was a large-scale crisis driven by geopolitical tensions. Adding another layer to the drama, Canada threatened to reduce electricity exports to the United States if the administration persisted with harsh tariffs. The integrated power grid between the two nations meant abrupt changes could cause blackouts and soaring prices in various states. People wondered whether these threats were mere bluffs or the start of an unprecedented energy standoff. Although a complete severing of power supplies wasn't straightforward, Canada's leverage was obvious. By gradually cutting output or raising electricity prices, they could apply real economic pressure on American consumers and manufacturers alike. The potential for higher utility bills added to the existing fears of job losses and rising living costs. Beyond electricity, Canada had other potent weapons. Cutting the flow of steel, nickel, and vital crude oil to the United States could disrupt entire sectors of the economy, from automotive to technology. If that happened, the ripple effects would magnify the crisis, pitting allies against each other in a trade battle that could reshape North American commerce for years to come. While the White House projected defiance, regional leaders were less confident. Northeastern states reliant on Canadian power worried about blackouts and costly energy transitions. Manufacturers fretted about potential supply chain bottlenecks. Families braced for steeper utility bills. The sense of unity that once bound both nations seemed in danger of unraveling. Amid these tensions, another global force stepped onto the stage. OPEC decided to cut production, driving up oil prices at the worst possible time for America. Higher fuel costs not only hurt everyday drivers but also squeezed sectors like trucking and shipping, piling more inflationary pressure onto an already strained economy. In response, the administration vowed to ramp up shale oil production to reduce dependence on foreign suppliers. But extracting shale profitably often depends on stable or high oil prices, which weren't guaranteed if international markets turned volatile. Environmental concerns and stricter lending policies further complicated the push for more domestic drilling. Meanwhile, the electric vehicle revolution gained pace worldwide, meaning long-term demand for oil could weaken. If the global transition to EVs accelerated, large expansions in shale could prove risky and leave producers vulnerable. It was a complicated chessboard, and officials had to consider moves beyond short-term fixes. At the same time, U.S. agricultural producers faced a devastating blow as China slashed imports of American farm goods. Once a gigantic market for soybeans, wheat, and meat, China pivoted to other suppliers in South America and Europe. American farmers, already squeezed by unpredictable weather and narrow profit margins, struggled to find new buyers. This shift hit rural communities hardest. Farm incomes dropped, storage facilities overflowed with unsold crops, and equipment purchases stalled. Many producers questioned how long they could survive under these conditions. The dreaded word bankruptcy began to surface, raising the emotional stakes for regions that had placed their faith in the administration's promises. China also replaced American energy shipments with Canadian oil. As Canada increased pipeline capacity, Beijing found a reliable partner to fill its energy needs, bypassing the United States. This deepened the sense of isolation, as longtime trading partners formed new alliances, leaving the American economy with fewer options. All these strains coalesced into a broader confidence crisis. Consumers grew uneasy when faced with higher prices on everyday goods and the prospect of layoffs. Business owners delayed investments. Local governments worried about reduced tax revenues if commerce continued shrinking. People realized it wasn't just a volatile market session. It felt like a structural upheaval driven by tariffs and standoffs. Wall Street watchers highlighted how quickly $4 trillion in stock market value evaporated. While recessions generally unfold over time, this meltdown compressed fear and losses into breathtaking speed, sparking flashbacks of previous economic crashes. Some experts suggested caution, hoping the situation might stabilize if cooler heads prevailed. But the administration's statement signaled no plans to reverse course. As public appearances were mysteriously canceled, questions about leadership arose. Normally, investors count on timely guidance from the executive branch. Instead, press briefings vanished, fueling speculation that the administration had no coherent plan to calm markets. Absence of communication emboldened critics to claim that officials were dodging accountability. Each passing day compounded the sense of a self-inflicted crisis. The economy had been on steady footing, with low unemployment and respectable growth. Yet these policies, if continued, might prolong the damage. People asked whether short-term political gains were worth sacrificing the stability of millions of livelihoods. Eventually, the unraveling carried beyond national borders. International experts from Europe and Asia warned that the ongoing trade wars and energy disputes could push the globe into a recession. Investors in distant markets sold off American assets, believing the unpredictability would only worsen. Whatever happened next, the United States was losing the confidence of global financial circles. Despite the dire signals, the administration doubled down on its narrative that tariffs would somehow bolster American industry. Supporters argued that short-term pain could yield future benefits, but the scale of losses made that argument increasingly difficult to maintain. Businesses, banks, farmers, and families all clamored for relief. If the turmoil extended further, a significant downturn appeared inevitable. Stock traders braced for deeper sell-offs. Large corporations reconsidered expansions. Households tightened budgets to endure an uncertain road ahead. The once vibrant economy stood at a turning point, with the next steps shaping the nation's future for years. In the end, it wasn't any single policy or negotiation that caused the calamity. Instead, it was a sweeping tide of decisions that escalated tensions instead of finding solutions. The meltdown became an unsettling testament to how interwoven the global economy is, and how quickly trust can vanish when protectionism overrides collaboration. Americans, meanwhile, faced the consequences in real time. For some, it meant job insecurity or depleted retirement savings. For others, it meant rising interest rates, making everything from mortgages to student loans more expensive. Faith in a stable economy wavered, replaced by frustration at leadership that offered little clarity. The stark realization was that, while tariffs might target one region or product, their impacts cascade across borders. Factory workers, farmers, airline employees, and tech engineers alike felt the repercussions. The meltdown exposed how reliant communities had become on worldwide trade and integrated supply chains. Observers concluded that reversing this collapse would require genuine diplomatic outreach. Rebuilding ties with Canada, regaining China's trust, and engaging OPEC in productive dialogue might calm markets. But forging those connections demanded humility, a commodity seemingly in short supply within official circles. As tension lingered, the next chapters remained uncertain. Would new negotiations bring compromise, or would punitive measures escalate further, fueling the crisis? Each day that passed carried the potential for deeper economic wounds. The stakes were unprecedented and the clock was ticking. Some held out hope that common sense would triumph, that the broader interest of national prosperity would overshadow short-term political goals. But without swift steps to mend alliances and restore the flow of global trade, the U.S. faced the risk of prolonged stagnation. Whether the meltdown was the wake-up call America needed, or just the start of more volatility, remained unclear. Investors hoped for a pivot toward pragmatism. Families prayed that jobs would endure. Business leaders waited for official signals that might ease concerns. Yet any optimism was tempered by the magnitude of the damage already done. Amid all this uncertainty, one truth stood firm. Economic fortunes can change faster than anyone imagines. Once confidence breaks, it takes real leadership and tangible policy shifts to heal the wounds. Without that, each day threatened a deeper slide. The meltdown underscored that no single economy, not even America's, can stand apart from global trade. As the U.S. confronted shortages, inflated costs, and frayed alliances, the consequences of isolationist policies became heartbreakingly clear. Recovery, if it came, would hinge on collaborative frameworks, not unilateral standoffs. In that sense, the crisis presented a stark lesson. Governments can't expect to shield domestic interests with tariffs without blowback. The global marketplace is vast and interconnected. Attempts to weaponize trade can leave countries fighting themselves rather than solving core issues. America's economic might once inspired envy. Now it found itself tested by its own approach. While the final outcome wasn't written, the meltdown illustrated the fragility of modern finance, the complexities of global energy supply, and the high stakes that come from ignoring economic interdependence. If a resolution emerged, it would likely require reversing harmful tariffs, encouraging cross-border cooperation, and addressing the root factors of inflation and resource distribution. But such a pivot demanded a willingness to concede mistakes, particularly at the highest levels of power. Until then, households watched their budgets tighten and their retirement accounts shrink, uncertain about the months ahead. If the meltdown taught any lesson, it was that trust is easy to lose and incredibly hard to regain. For now, Americans bore the consequences of policies that aimed to fortify their economy, but ended up weakening it instead. In the midst of the crisis, business leaders, governors, and even foreign officials called for clarity, urging an end to retaliatory cycles. If those calls went unheard, the meltdown would continue, with new financial jolts waiting around every corner. The nation and the world held their breath, waiting to see if the administration would stay its course or finally turn back.